In today's complex financial landscape, consumers in Ireland need to ensure that they are receiving advice from the most qualified professionals. The QFA, RPA, and notably the Certified Financial Planner designation are the hallmark of excellence in financial planning. Each signifies rigorous training, a steadfast commitment to ethical standards, and to continuous professional development. For somebody who is selecting a financial planner with these credentials, a consumer is entrusting their financial future to somebody who is comprehensively equipped. It is not merely about choosing a planner, it is about securing a sound and prosperous future with the guidance of a true expert.
Hi there and welcome to Pension Awareness Week session on keeping your pension on track. If you've joined us today, it's quite likely you already have a pension in place. Having been set up back in 2019, the objective of Pensions Awareness Week was and still is to empower people and companies in Ireland to take charge of their pensions. For some people, keeping an eye on their pension is easy, and for others, not so much. One thing that is relatively easy to do is to review what you're invested in. The last 12 months have had their fair share of drama. There have been bank failures and price falls, but also asset price recoveries in some sectors, an improving inflation trend, and continued economic resilience in most of the developed world. Many of us have seen significant variations during the year in the value of our pension pots. Whether it's market ups and downs, new investment opportunities, or new attitudes to existing investments, having a grip on how your pension is invested can make a big difference to your future. So this session looks at how people in Ireland should invest their pension in 2023 and beyond. Firstly, we're going to consider what has happened in the markets over the last 12 months or so to make sense of it from a pensions point of view. And secondly, what's the outlook from here? Which regions of the world are hot and which are best avoided? Should you reallocate in or out of equities? What's the outlook for commodities and bonds? And lastly, how should you, as a pension investor, respond to this? Should you react at all, or is that the job of your pension fund manager? Now, as we discuss these questions, it is important to say at the start that nothing we are discussing today is personal advice to take a particular course of action on. When it comes to investments and pensions, everybody's situation is different. There are lots of resources on the pensionsawarenessweek.ie website to help you to get advice on your specific situation. And joining me to discuss these questions is a panel of experts from across the Irish industry, all steeped in investment markets and the world of pensions for more years they'll probably care to admit. Our first guest is Rafe Benson, a co-founder of online investments and pensions advisor moneycube.ie, a chartered accountant, a qualified financial advisor. He's also a tireless advocate of straight talking and action when it comes to pensions. Welcome, Rafe.
Hi, Grania. Nice to be with you. Our
next expert is Stephen Grissing. He joined Davy in 2012 and works on tactical asset allocation within Davy multi-asset portfolios with a focus on fixed income and currencies. Stephen is a chartered financial analyst and prior to joining Davy was a professional rugby player with Leinster and in the UK. So after this discussion we're going to talk about the Rugby World Cup. Stephen, are you okay with that?
Absolutely, go on. Thanks.
And lastly, we have Mark Riley. He joined Royal London, Ireland in 2019 as Pensions Proposition Lead from Aviva. Mark has led the launch of Royal London, Ireland's pension offering, the first new entrant to the Irish market for more than a decade. So let's look at the world in general at the moment, Rafe. It feels like, to put it mildly, is a volatile place right now. War in Europe, political drama in the US. It's ongoing, global decoupling and inflation. How does that affect your pension?
Yeah, great question, Grunya. And it's true, like that. If you read the news, there's it can be a fairly depressing read these days, and whether that's climate affecting how people are spending their money, or the fact that the US, China are increasingly at loggerheads and almost splitting apart their kind of spheres of influence, if you like, and spheres of industry, and that's impacting on Europe as well. Like you can see it in, say, the car industry in Europe, where there's talk now of, Europe putting tariffs on Chinese car imports and so forth. So, like, it's certainly the case that if you look at the kind of global economic news and geopolitics in general, that there's a lot of negativity around. But by the same token, the global geopolitics is not the global economy, and the global economy is not the stock market. So I think, actually, if you turn to the story of what's happened in investment markets this year, it's a much more positive picture. It's a story of recovery. It's a story of quite sustained economic resilience, actually. Many people would have thought that Europe would be in recession by now, had you asked them a year ago. And actually Western economies have proven very resilient, So actually, I suppose what the news does is affects your confidence.
Yes.
And confidence is so vital, both in markets, but also as an investor in your pension.
Because it is like a natural reaction to become conservative when there's a lot of unrest, to sort of hold back on doing anything. But it's interesting what you're saying there, that politics is not economics, even though they do seem to be presented to us in the media as very much interlinked.
Yeah, well, that's right, and clearly they impact each other. But I suppose the thing about it's not the case that everything's always rosy, but there is a time in investment markets when one needs to move from a defensive position, which is all about preserving wealth and preserving capital, to actually, the whole point of investing your pension is to make money over quite a long period. Mm-hmm. And it's I guess a big question for people like us in investment markets is, when is it right to resume that risk on posture? And it's by the time, interest rates are falling, recessions are happening and all that kind of thing, mm-hmm. It's probably too late to be thinking that through. So I guess a big message for me today would be, how do you begin to kind of be risk on and be ready for that recovery, some of which has already come through this year, but, picking out those spots where there's further recovery and growth to come.
Okay, Stephen, I suppose Rafe has given us like a very broad overview, but it feels like you almost need to be reading the future to know what's going on. What is the story of the year with markets and investments?
Look, I'll start on a positive note here.
Good.
You'll all be glad to hear.
Yes.
There is a lot of concerns out there, but as we've heard, markets have been resilient in the face of it. And I think especially when you compare it to what we're coming off in 2022, when there's no sugarcoating it. It was an awful year for investors in really any financial asset, apart from maybe oil or energy. Mm-hmm. Everything else was pretty much in negative territory. So the good news this year is that we're actually, look at global equities, for example, up in the mid-teens as we stand today on a year-to-date basis. Even go then into different asset classes, into corporate bonds, the safer investment grade bonds, maybe 2 to 3%, depending where you're investing in US or Europe. If you take a little bit more risk and high yield, you've actually gotten like 6-7% there. So global government bonds, probably a bit less positive, maybe flat to slightly negative, but we'll get onto that in a bit more detail in a while. But overall, it's been a very positive story this year, especially when you compare it to last year. Maybe at times we feel a little bit too good, but we'll focus on the positive for now.
How can it be too good? Is that like you're waiting for something to happen then?
I think when you look at, we've touched on some of the concerns, and look, there'll always be concerns for investors, but I think if you look at where even equities are today, I heard something the other day saying that the S&P, it's around that 4,500 level, say around 3% off its all-time high, roughly, depending on what day you look at it. But I think when you look at where we are today, interest rates at levels that they just haven't been in a long time, we're still waiting from that lagged effect to come through from those interest rate increases. It generally does take 16 to 18 months or so in the US, what we would have seen typically, for those interest rates to filter through fully into the economy and have an impact. The US is obviously looks very resilient, less so in Europe. But when we say that, we're still seeing equities in Europe up mid-teens as well. So I'll start, as I said at the start, I'll start on a positive note. Things have been very good this year. There is a bit of maybe at times, given where we are, maybe it's been a little bit too good, but who's to say it's not going to continue for another bit longer at this stage?
What we all need is a crystal ball, really, isn't it? Mark, I'm going to come to you. The innovation story of the year, and everybody is talking about it, is the explosion of AI. It seems to be touching every area of our lives. Do you think it has, I suppose, a point of contact with pensions and investments?
Absolutely, and I suppose, sometimes when we hear the phrase AI, we all start thinking about, autonomous robots or robots going rogue, and the demise of humankind is portrayed in many Hollywood films. And
Skynet.
Yeah, Skynet, absolutely. And unfortunately, probably given a bit too much credibility with some sensational headlines. I mean, for me, when I look at it in the context of pensions, AI is really about looking at efficiencies, accuracy, and kind of personalization. And you're then looking at, I suppose, what can it do as a tool? And I suppose the way we'd often see it in our day-to-day lives would be, if you're interacting on a particular website, say with a chatbot, to deal with, very simple customer queries, or you're using it then for machine learning to spot particular trends, maybe in our industry. Or lastly then, that you're looking at putting in place, as advisors, maybe personalized solutions for clients through the use of data analysis. But, I think as an industry, we're probably still at the beginning of the journey. It's one I think we're up to the challenge on, because I think the use of AI, while I don't think it's going to replace human expertise, it can only serve to enhance, our capabilities. And if that means, better risk management, better client engagement, better client satisfaction, well, I think then AI is a tool we have to embrace rather than run away from.
That's very positive, and I suppose realistic kind of assessment of it's coming.
Yeah.
And we have to deal with it.
And it probably resembles maybe, 20, 30 years ago, as the internet took off. Again, it was probably a technology that people, in some regards were fearful of, but have now since embraced, and it has transformed our lives. And I think AI will prove to be something similar. It's really taking that next step with technology. And, it's up to us in the pensions industry, the three of us here today, as to, how the organizations we work for, how they're going to embrace that technology in the right way, and that will deliver good customer outcomes for our clients.
So that's, AI, which is a very particular part of technology. What about the broader technology sector and where it's going from here?
Yeah, I mean, I guess technology stocks have driven markets for the last decade or so in a big way. It's, on the whole, it has been much more interesting to be in big tech, typically US big tech, or some of the big growth stories out of China, to make real money in the stock market. And those kind of more durable stocks, like a Unilever, a Procter & Gamble, or something in the energy industry, has been a less exciting place to be. And actually that has, by the same token, in 2022, all of those stocks sold off in a big way. Meta down kind of 70% or more, and the bounce back has been remarkably quick. So something like 70% of the return in the S&P 500, which is the US index of top 500 companies, so like a big old index. 70% of that return comes from the so-called Magnificent Seven, which are these, the Alphabets and Meta and Nvidia and so forth, that we, the big US tech firms. So, like, I would say, firstly, US tech has had a very strong recovery. Some of that is on the excitement around artificial intelligence that Mark is talking about, and I think there is genuine room for excitement. Say a word on that in a minute, but like the Magnificent Seven and their fellow travelers, if you like, have done a good job of learning how to adapt their business in an era where interest rates are higher, where they need to actually learn how to control their costs. You know, they had recruited an awful lot of people in a short time, and like locally that's been pretty unpleasant for a lot of people working in the Irish tech sector. But it is actually, as an investor, without wanting to be crass about it, it has been a sign of health in those businesses that they're prepared to run them in a sustainable way, and ultimately for Ireland Inc. that we need them to be sustainable and back on a growth trajectory. So that's been valuable.
So becoming leaner operations is actually good news.
It's pretty unpleasant at the time, and you know, we probably all know someone who's been on the sharp end of that. But I guess you know, that is also efficient deployment of capital, which as investors and even as people, you know, working in the Irish economy, we want to see, because that means, you know, the trick can be repeated, if you like, you know.
Okay, Stephen, everybody gets excited about stocks and shares. You know, it looks great. You know, even if you're just watching it go by on the TV screen, there's an energy about it. But the bond market is bigger, and it seems there's more drama to come. Tell us about that.
Yeah, you're right. Most people probably listening in today will follow stock market more closely probably than the fixed income or bond market. As a fixed income strategist, I've had to accept that a while ago and move on. But yeah, you're right. There's just the fixed income market globally is actually bigger in size than the global equity market. So that's probably something some of your listeners will be a little bit surprised to hear.
So why is it that is it trouble getting the attention focused there, or is that a good thing in a way?
I think it comes down to two main points. I think probably the first one is you've touched on a little bit with equities, the likes of particular companies, say whether it's Apple or Nvidia more recently. There's kind of exciting news stories, new releases of products, things like that, versus maybe say a government bond, like say a German 5-year government bond. Maybe less exciting news stories coming out of the German government, for example. The other point I think which plays a part is that for bonds versus equities has been there traditionally what we've seen in terms of the returns that you would have gotten there in previous years. So for bonds, traditionally it's been kind of this slower, gradual, albeit lower returns than what we would have seen. Less volatile, but lower than what we would have seen versus equities if we go back over a longer time horizon. 2022, that was pretty much thrown out the window, that kind of slower, steadier return kind of framework there around bonds. And what we got in 2022 was over any reliable records that we can see is government bonds had their worst year that we can see on reliable record at least. So
why?
It comes down to what we're seeing, going back to the inflation and central bank reactions. So 2022, just to put it in a little bit of context before we go into some of the details, global government bonds sold off around 15 to 16% in dollar terms. Go back over time, right back to the 70s, 80s, look at all the kind of worst years in each of those decades. The closest we probably would have come to that is around minus 5% for a year. So compare that to minus 15, 16%. That'll put in perspective just how bad 2022 was. And going to your point on why it happened, central banks clearly initially thought inflation was going to be a transitory story. It was going to just not stick around as long as it has been. So as a result, they were kind of caught on the back foot and had a lot of catching up to do. So what did we see in the US? We saw the Fed implementing rate hikes to an extent and a pace that we haven't seen since, go back to Paul Volcker there, some of your listeners might have heard him before, the head of the Federal Reserve back in the 80s when inflation was at really extreme levels before. So as a result of that, what we did see, we saw central banks ramping up interest rates. As a result, we saw bond yields rise higher quite dramatically with as interest rates went up. And that's where you get bond yields and bond prices move in opposite directions. So we got yields moving dramatically higher and prices of government bonds falling dramatically in 2022. So that, I think, has been, you mentioned at the start, the drama that we've seen in the government bond market, which traditionally we don't expect to see. But I suppose the good news, I think from here is that 2022, in my view, represented just a very sharp reset in the government bond market. So now, even where we are now, you're seeing bond yields at much higher, more attractive levels than we've seen in an awful long time. So I think that's not been lost on investors as well. If you look at just some of the inflows into bond instruments, investment instruments, so exchange traded funds, look at the US in the first half of this year, you saw the inflows into bond ETFs far exceed the inflows into US equity ETFs, and that's even given what's been going on in the AI space and the really strong returns in the equity market. So that really, we're seeing a similar story in Europe as well. The first half of the year, we're seeing record demand for European bond ETFs as well that we haven't seen before. So there is an opportunity there, and I think investors are really aware of that now, but it has taken quite a lot of pain in 2022 to get to where we are today.
Okay. Mark, Stephen mentioned interest rates and inflation there. People are genuinely worried about this. It's making a difference to their everyday lives in terms of cost of living. Are we in a new era for interest rates?
It does feel like we are, Gráinne. I mean, if you look back over the last kind of 12 to 18 months, you look at what has happened with interest rates. And I suppose prior to that, people probably looked at interest rates and inflation as quite abstract concepts and probably felt it wasn't really touching their everyday lives. But I think for a lot of our viewers, particularly those who are maybe on tracker mortgages, they are feeling it. You know, every couple of months they're probably waiting to see what the ECB announce. But, you know, even I suppose things like inflation, you know, inflation is down now to 5.3% as of last month from a record high of 10.6 in October of last year. But even from, you know, as a kind of an example, Friday night in the Riley household is typically homemade pizza night, you know, and you'd be going down to your local supermarket to buy, you know, a couple of bags of mozzarella. And this time 12 months ago, they were typically 99 cents. And I remember going down last Friday and I don't know why I even thought of it. And I looked at the price and the price was like 139.
Yeah.
That's inflation, you know, in a real life everyday concept, that something like that has gone up by 40 cents in the space of 12 months. So you can see why people are feeling the pinch in the pocket, particularly then if that's coupled up with, you know, obviously rising interest rates. And, you know, for people who haven't maybe fixed and are still on a tracker, they're waiting with bated breath today to see what the central bank do with rates today. I mean, I heard on the news before we came to our discussion this morning that, you know, there is in some quarters they're predicting that maybe the central bank will take breath and pause, maybe just for this month. But I think it's fair to say that, you know, I think the three of us would probably expect that rates will go to 4%. But how higher they go after that, I think it's proving now for the ECB, it's quite a difficult, I suppose, channel to navigate, because at one stage you're trying to use the interest rates to dampen down inflation. I mean, we're still at 5.3, the ECB target is 2, but, you know, with rising, you know, costs in oil, with a weakening euro, it's such a hard channel to navigate, to try and, you know, use one tool to fix another. So, you know, it's really how far the ECB intend to go with their interest rates to keep inflation in check and to hopefully see a reduction in costs in those bags of mozzarella.
Low cost mozzarella, that's what we want. Go on.
I think you're right. The ECB, given what's going on in the economy at the moment, and some of the data coming out of Europe is not looking so pretty anymore, especially some of the services data, where it's manufacturing or servicing. I think that they will be conscious of that as well, obviously, as they continue to fight inflation as well. But I'd imagine that they probably feel I think it's more difficult now for the hawkish members of the ECB, the ones who've been pushing for more rates, to actually justify pushing them higher from here. But I think longer term for investors and people listening in today, it does feel like we are in a bit of a new era. You go back to the past decade, we've largely been in a negative rate environment in Europe. Markets pricing in the next 4 or 5 years rates to fall in Europe around 2.5%, 3%. So it's not back to the 80s as you mentioned at the start, but it seems like it's going to be a little bit higher than what we've seen over the past decade at least.
Okay, Rafe, Mark mentioned people who have mortgages, people who are following tracker rates and nervous about it. Property as an asset class amongst all of us here. We are so traditional about property in this country. You know, many people view property as a pension in itself. Talk to me about that as an asset class, property.
Yeah, well, property has been on a roller coaster of its own, really, I suppose, over the last, well, even if you take a 10-year view, and I think, as an investor, when you're looking at property, you need to chunk it down into some quite distinct classes of assets. Now, as you say, in general in Ireland, we are overweight Irish property and cash. There's north of 120 odd billion quid sitting in deposit accounts in Ireland for household money, and we do love property as an asset class, and lots of people have done very well out of it. In particular, it's an asset you can gear up, you can manage yourself, you can control it. It's in a sector you understand, and
does it feel because it's more tangible, people are more confident then?
I think there's something about that, and of course that's a failure of the pensions industry not to make people's pensions tangible to them. And we were talking about a client the other day who had received their pension statement, and kind of they looked at the value on it, and it was off by 20% from what they were expecting, and in terms of money they'd put in, and they kind of went, oh, okay, I'll just pop that in the drawer. I wouldn't have expected that, but I guess the pension company's right. Whereas if that were your bank account or a valuation on a house you owned, you'd be banging down the door. Yeah. So there is definitely something about how we feel more distant from an asset if it's sitting in our pension, but that is as valuable and tangible an asset as anything that you have the keys to the front door on, or your current account, or whatever it is. So
that's a really important mindset change that people need to make, isn't it?
I think so, and we as an industry have need to get better in terms of dashboards that pull this all together for people and break it down in tangible terms. And you do own a little piece of Amazon here, or whatever it is. So I think that's the Irish property piece, and it comes with a whole set of risks of its own, not least. You're probably, your biggest investment already is the house you live in, and while it's interesting to, and perfectly possible to put property into a pension, there's going to be other things to think about there in terms of what are you going to do with the rental income, how are you going to manage it, what's the effect of the interest rate rises we're talking about within your pension, and so on. So it comes with its own kind of set of questions. I think then totally distinct from that is what's going on in the global real estate market, where most people will have some exposure through their pension, and that is all still being worked out. The return to the office, to the extent it happens. Certainly commercial like office prices, rentals in Dublin, are on a significant downward trajectory, and you only have to look at the kind of for let signs around town to see that for oneself. Out of town warehousing, so funds that have basically built the warehousing and logistics for the home delivery infrastructure that we want, that is under severe pressure, and again a very debt driven investment class, and then there's the whole kind of change in how we shop. So that's leading to all sorts of kind of city centre vacancies. The UK is in the throes of going through Wilco, which is a kind of, I don't know what you call it really, a sort of bargain shop selling big chunky items in the centre of town. 12,000 people are losing their jobs this month, as that business meets its end. So there's a huge amount of change in that kind of that whole property sector. It is appropriate, I suppose, to have some exposure to that asset class for many people, but one needs to tread with care. And certainly if it's Irish property, I'd be saying to any investor, you probably already have a lot of exposure to property on a little rainy island in the west of Europe. Do you need more, or is there in itself a diversification benefit in putting some of your other wealth into non-correlated assets that are not going to have the same ebbs and flows as Irish property?
Feels like for some people that'd be a hard habit to break.
Yeah.
But I'm sure you could do it. What about other asset classes then, like crypto and commodities?
Yeah, I guess like if you look back over the last couple of years, there was a lot of cash being put into people's pockets, and people were sitting at home with not a whole lot to do, and that led to some investment crazes. Now I would say, crypto interesting asset, like a bit like the artificial intelligence thing, in that there are a few rounds to go until we figure out, who the winners and losers will be in that. So I would say, that hasn't been worked out yet, and in particular on crypto, we don't know if cryptocurrency is either an asset which stores value, which seems questionable given the crazy falls it's had over the last couple of years, versus something that can actually provide some sort of income and be a medium of exchange, and you can actually do things with. So there's a lot to be worked out just on a very fundamental level of what are cryptocurrencies for, and then we can begin to decide if they're investable assets.
So you'd be hanging back there, wait and see.
I think it's pretty unfashionable for pension advisors and so on to recommend putting that in that. But I also think, if people, I don't criticize customers who've put some exposure into that. Lots of people have made money in doing that. If it's play money and you're experimenting and you're buying a little bit of lots of different coins and it's money you're prepared to lose, that's different from investing your long-term wealth over many years in professionally managed assets that are well understood. Almost. So I guess you can certainly lose a lot of money very quickly in those kinds of assets. So that's the health warning. So it's certainly not something we're doing, but I always think it's a bit of an annoying thing to hear from the investments world that
you're fun.
Yeah, exactly. Yeah. So
it's not about fun. It's about having fun later.
On the fence there.
Yeah, I hear you, Stephen. All we're hearing kind of throughout this conversation is volatility, change, new eras. The game hasn't played out yet, so there's a lot of unknowns. Is doing nothing an option during a time like this when things are swirling around you and you don't know where it's going to land? Is just standing still an option?
I think if by standing still, if you mean keeping your money under your mattress or in your bank account, if that's the suggestion there, and you still have quite a considerable time horizon left before you retire, well then we wouldn't be recommending that's a sensible thing to do. Obviously, we're all aware of the low level of interest rates that are available on deposit at banks right now. So for someone with still whether it's 15, 20 years plus to retirement, you need to be taking a bit more risk. And what's going to be, we talked about inflation already today, but by leaving your money at the bank or under your mattress when inflation in Ireland is around 5-6%, you're actually eating into the purchasing power of so that money in a year's time is going to be worth less than it is today. So you need to try and make that work for you and put that to work. I suppose for people who actually do have requirements for that cash over the next 1 to 2 years and are a bit more concerned around investing that in the markets now because they need that, they have a need for that cash in the shorter term for that liquidity requirement. Well, thankfully for those people, there are actually alternatives available now versus the very low levels of interest that you get on your bank deposit. So things like money market funds, which attempt to track kind of more like the interest rate at the ECB with a bit of a lag, but invest in shorter term debt from governments or companies which have quite solid balance sheets and are seen as safer investments. You can actually get, obviously, if the ECB, if we think they're going up towards that 4%, you'd be able to get even a little bit below that. So considerable pickups from what you'd be able to get from just leaving your money in cash. But going back to your first point, if you still have a decent time horizon, and the thing about time is generally your friend. The longer
it's not.
The longer the time horizon you have, by looking at some of the other assets that we've mentioned today, like equities, getting exposure to those, you have time to ride out the bit of volatility that you might see if you do see dips in the market. There's kind of, I think a lot of people might be aware of it, but for any listeners who aren't, this kind of wall of worry chart, or it generally shows maybe I'd say the MSCI World or some index like that over time. And say if you go back to the early 90s on that, you'll see endless endless concerns or events that happened that people would have been concerned about in the run-up, even at the start of this year. We've had the US regional banking, which potentially could have turned into a larger crisis. We saw the debt ceiling issue as well. Things like that. There's endless things that are kind of coming at investors or people who have a pension that they will be concerned about. But over time, take that longer term view. Go back to the early 90s for the MSCI World, you average out around 7% despite all of these endless things to be concerned about. So go back to your point, I don't think just sitting still and not doing anything, if you have especially if you have a longer time horizon, is recommended.
I think the thing as well about doing nothing is, like, if you're going to do nothing, know why you're doing nothing. So don't just do nothing because
You're frozen with fear.
Scared to act. It might be perfectly legitimate to have a plan which involves, for the time being, retaining your firepower, ready to do something when circumstances change. So it's all about being deliberate with your money and having a plan that goes beyond just dealing with today's conditions, because, like you say, we know for certain tomorrow's conditions will be different.
Yes. The main thing I am hearing is that change never stops. There's always going to be something coming at you, but if you have long enough to plan, you can ride it out. Mark, are there core exposures your pension should have at least some of the time?
I wouldn't necessarily advocate a specific investment exposure. What I'd be putting forward is that you're really looking to have a broadly diversified portfolio. And again, this is something that both Stephen and Rafe have touched on. And that's I think a very effective way of investing, but it's also a very effective way of balancing risk. And I suppose I'd argue that it's critical for any of our viewers who are looking at long-term investing or putting money into a pension over a long period of time. And what you're looking at doing there is, and you kind of touched on it, Grania, was that change is a constant. But if you're broadly diversified across different asset classes, be it equities, be it bonds, be it property, be it cash, it means then if one of those asset classes takes a knock, you're hoping the other three, mightn't do the same. And because you have that broad spread, then you're not exposed to one single asset. And that's why I think for all of us, having that broadly diversified portfolio is the way to go. And again, people will often maybe shy away from, well, which one of them should I go into? And again, it comes back to the importance of sitting down with an advisor and doing something like what we refer to as a risk appetite questionnaire. And really what that questionnaire is trying to out is, what your tolerance is for risk, for loss. And usually the answers that come out of such a questionnaire is where, the likes of Rafe as an advisor is going to then say, well, look, what the questionnaire is telling us is that maybe you'd like something that's more heavily weighted to equities or heavily weighted to bonds or property or cash, or maybe you're quite a balanced investor and you want maybe 25% in each. And that's that's why it's so useful to go through that kind of exercise, sit down, and then you'll have a better understanding of where your investment exposure should be. And maybe it should be spread over a range of different assets.
So you can personalize it.
Exactly, because I think one of the things you said at the very outset was that investing is different for everybody, but going through that type of exercise really then shines the light on you as the investor as to where you should be putting money that you're comfortable in actually doing.
So if you're a natural gambler, you might go, into something that's a little bit more turmoil, and if you're not, you can go for the slow and steady wins the race.
That could be the investor sitting in front of Rafe going, let's put it all into crypto or commodities, or let's go heavily into AI stocks. Or subsequently the next person who comes in, it's very much looking at that balanced portfolio, and maybe they are risk averse and they're like, well, I don't want to touch crypto. Because I want something that's not going to keep me awake at night if I hear news headlines about crypto funds, going down south or whatever. So, but it's really just trying to understand your own tolerance to risk and what kind of, investments are then going to reflect that.
Okay. So we're talking about a lot of crisis, which also means opportunity, Rafe, doesn't it? Isn't that the word? It's really the same thing, isn't it? So is there an opportunity to fill your boots when crisis is happening? You kind of touched on it earlier. I kind of get the feeling that if you're brave enough, there are opportunities. Yeah,
well, I certainly would not encourage anyone to run in the opposite direction, particularly usually by the time these things are filtering through to markets, it's too late to do that anyway, So I would say yes, to a degree, like more is more when it comes to pensions, right? So I would not encourage anyone to be, say, putting changing how they put money in, right? I would certainly stay the course on that. It might be that the investments within your pension you adjust, and just to position for some of the things that are coming on down the track. But I would certainly say, we've seen a recovery in that US tech bit that we talked about, but there will be news to come in the bond market. There's no doubt about that. In 6 to 9 months, the interest rate environment is going to look very different, and what you want to be there for the unwinding of all the things that have already happened, because as you say, the wheel turns, and it's being in those assets at the right time. So I would certainly say places that are looking interesting right now to rattle off some, but emerging markets look interesting. The bond market looks interesting, certainly. So there are definitely places where you can be looking to deploy fresh money at the moment, and it's certainly not the case that even there might be a 2-3% return on kind of no risk assets. That's not going to be the case forever, because interest rates will come off, and by the time they do, you'll have missed the opportunity to get into the other assets that are benefiting from the flow of funds into them. And I guess I'd say it's always more kind of somehow convincing for the pessimist argument, So people are afraid of looking silly by making big optimistic projections, because it's as if you're ignoring all risk. But one can be optimistic about the future without dismissing the fact that it contains risk. So I was looking at some survey recently that McKinsey of all people had handed to AT&T in 1980, and they said, sagely, that their firm view was that by the year 2000 there'd be 900,000 mobile phones in the US. Yeah, so AT&T, leading US phone company, looked at that and said, well, that's a pretty tiny market. I don't think we'll be bothering with that, and they never got into the mobile phone game. So it was an easy, had they come along and said, we think some people are going to have 2 of these things in their pockets by that stage, and then you're going to ship 300 million of them, and we're going to replace them every 2 years, and it's going to be, nobody's going to have a landline. That would have fundamentally changed their business strategy, but of course that would have been a radical and very optimistic statement to make.
Really radical, and people
Risky.
might have said you're crazy.
Yeah, so I think I would just caution that when you hear in the news, as we surely will, the downside risk being emphasized, I would just say that's, we have a bias as, we've evolved to be alive to risk in the jungle, and, what's going to eat us for lunch and all that kind of thing. So it goes to our instincts to be alive to those risks. But actually, your pension and your investments and your wealth overall is going to be made not by by kind of staying and wondering what's going to eat you for lunch, but actually taking some calculated and diversified risk across your pension. And that's as true as it is today as it has been in the bull market of 2021.
Mark, if you were planning to retire early and you have been bitten by some of the movements that have happened in the last couple of years, is it a massive setback, or can you recover?
I suppose it depends really on, when you actually drew down your benefits, obviously very much what you're invested in. And the whole notion of retiring early, I suppose, it's not uncommon. I mean, we did some research in Royal London, Ireland, that, 36% of Irish people, want to retire at 60, another 21% would be going at 50 if they could afford to, and then 1 in 5 then said they'd actually retire today if finances allowed. So it's not a concept or a notion that people certainly aren't aware of. But I mean, you certainly don't want to see anybody arrive, particularly if they've built up a lot of funds and they arrive at that scenario when they go to pull the trigger and obviously hit retirement and enjoy the fruits of their labour, that they're doing so, maybe they're invested in the wrong way and they're retiring when maybe the majority of the asset class they're invested in is after tanking. None of us want to see that. But again...
And it has happened.
It does, yeah, absolutely. I mean, there obviously have been periods in history where, be it equity markets or, property crashes or whatever, it just reinforces the importance of sitting down with an advisor, mapping out, I suppose, what your approach to investing is, what the right investment strategy for you is, and very much trying to plot, well, where do you think you're going to retire, or when do you think you're going to retire, at what age, putting in place then an appropriate investment strategy that is going to get you there, and maybe that you are de-risking as you approach it. And I suppose, look, people have to understand that, there will be obviously turbulence along the way on the journey, but, very much getting the landing is very important, for people, so that they don't go through that kind of, big correction, the day they come to retire. So, but again, it's really just about sitting down, doing the advice piece and making sure that you're having those regular conversations with your advisor.
So how regular should you be chatting to your advisor? How many times? Should it be once a year, a couple of times a year?
I mean, Rafe's probably the guy to ask on that. I mean, I suppose from my perspective, at least once a year, I think you should be sitting down and reviewing, particularly your pension, whatever about other, obviously, financial products you may have, but your pension, at the end of the day, that's what you're hoping to live off once you finish work. And I think, probably next to your house, that's probably going to be your second, if not your biggest asset, hopefully, all going to plan. So that's the one that does deserve a good bit of attention, and one that you should be looking at frequently.
Yeah, I think as well, it's not necessarily about, this is my, 2 days after my birthday every year, I look at my pension or whatever, it's situation based. Yeah. So, if your circumstances have changed, you've moved a job, your family's looking different, or, you're coming into retirement, clearly those things, that's when you want an advisor around. So what we say to customers is, we want to be there when we're needed, not just turning up on an appointed date and having, trotting out a kind of very fixed agenda. It's about being there when maybe markets are looking choppy and the task is to reallocate or to talk someone down off a ledge or whatever it be. So I would say, it's to do with where your situation's at. I mean, if everything's great and you're trucking along fine and you've put a good, durable, sustainable plan in place, you might be perfectly happy to just operate that plan for some time. Yeah. But when situations change, be it your situation, a market situation, so on, that's when you need advice.
Mm-hmm. So you need to be agile, really, and you need to, I suppose, keep your ear to the ground about what's happening.
I think so.
It's not a case of just signing on the dotted line and handing it over and forgetting about it. I think people have that idea in their heads.
No, I'd definitely say, ask a few questions of whoever is providing service on your pension, be that through your workplace, through your pension advisor, through your fund manager. Ask a few questions, and yourself, if you ask a question, you get a dodgy answer, you ask a few more questions. If you ask a question, you get a very coherent answer that actually addresses what you were worried about, then that's probably okay, and you might be happy to keep going for another little while.
Okay, we're nearly out of time, so I'm going to throw a couple of quick questions out. Mark, for somebody who's mid-career, what should they be doing regarding retirement planning today? I
think three things for me is, it's probably to take a pause, look back at what they've built up, if anything, assess where they are today, sit down with an advisor and map out a plan to get them to that finish line. Because, obviously the topic today is somebody mid-career. For a lot of people, mid-career is when you're really, I suppose, your earnings potential is probably at or near its best. So it's really about maximising your earnings potential now, putting some of that aside into a pension, and really powering up your pension now for that finish line in years to come. Stephen,
to the same kind of person who's watching, what would your big take home be for them?
I'd focus on human behaviour and our tendencies, and just practical takeaways from today to try and prevent those kind of human tendencies getting in the way of people listening in today reaching their end goal in terms of if they have a number in mind or what they need to get to for retirement. And very practically, if you were, habits is a big thing. So someone who's trying to eat, say, less chocolate during the week in the even time, remove the chocolate bars out of sight. I'd say for someone, I know it can be hard, but for someone bringing that back to your pension, is those human tendencies is, even if it's a thing of not logging in and checking your balance, say, over your portfolio on a weekly, say, basis, or every couple of days after, I'd say something like remove the bookmark on your internet browser just a little bit lower, keep it out of sight. I just trying to think of practical things, something like that will just, week to week moves in markets don't really count for much if your horizon is 10, 15, 20 years. So that'll be my takeaway from today.
Yeah, okay. And Rafe, Pension Awareness Week, all about practical actions that people can take to improve their financial futures. I suppose the same question to you. What is the first step? If somebody's going, oh my God, I have nothing done, I need to get my act together here. What is the first step that they can take?
Well, I guess what I'd say is nobody cares more about your pension than you do as the pension owner, right? You're the person who stands to benefit from it. You're the person who's going to save tax on it, and you're going to get the growth of it through. The sooner you start, right, is you begin to get growth through. So, it's that old, the best time to plant a tree was 20 years ago, whatever. So that's all fine. Try and forget about, slack off that past, but, it is really down to individual action, and if people come away from actually to prepared to in the short term take action to get control of it, get knowledge on where it's at and take steps to improve it. If you're paying too much, if you're poorly invested, if you're putting in amounts of money that realistically you would spend on on kind of a couple of coffees and your lunch and so on, I'd say if you want to do those things we're talking about, maybe change your career towards the end, start something new, cut down your hours, all those kinds of things. Don't expect the government or anybody else to help you. It is down to individual action, and there's lots of people around here who can help as part of the pensions awareness team, but it's that first step is down to the individual.
Absolutely, you have to take control yourself. Rafe, Stephen, Mark, thank you so much for your expertise today. We want to help you take charge of your pension, but that is easier said than done. So if you've heard something today that triggers you to think you might want to take action, the Pension Awareness Week team are on hand with practical ways to help you do that in different ways. There are options on the website that allow you to take action today, as well as complimentary one-to-one sessions from your Pension Awareness Week partner, moneycube.ie, for the next little while. That's all we have time for, so it only remains for me to thank our panel again for their involvement, and thank you, our viewers. There are lots more events on throughout the remainder of Pensions Awareness Week, and you can still register for them or watch the sessions that have already taken place. Tomorrow we will feature 2 webinars, one where I'll discuss everything to do with approaching retirement, and the week will conclude on Friday with Ryan Tubridy hosting a session on company pensions for SMEs. There are also plenty of videos available on a range of pension related topics that you can watch at your leisure, so be sure to log on to pensionawarenessweek.ie to find out more. But from all of us, for now, thank you and goodbye.